Dan Quigley, welcome back to the hot seat. Last time we were sat here, we were just about to go into the Scottish elections and wondering whether an SNP majority would move the needle on sterling at all and its future outlook. I think it's probably fair to say that it did next to nothing. And actually, to a broader piece, the market in that time has done next to nothing. So what exactly is or isn't, probably the better term, going on out there at the moment?
Well, yeah, as you mentioned, we've sort of seen a period of relatively low volatility in between economic events. The market is very much fixated on how each economy comes out of the pandemic and continues to rebuild. And it seems to be a battle between the central banks somewhat at the moment. We're looking at different data releases and how that leads into inflation expectations, and therefore higher inflation expectations in a particular country increases the likelihood of higher interest rates. As it stands at the moment, there's still a number of government support packages in place which are distorting the data. We've got base effects going on from particularly low levels last year. And we're just starting to come out of that again now, probably as we head into July and August. When we started to recover last year, those numbers are going to start to become more comparable again. But what we are noticing is that as we're progressing through the year, I think each major data event that we're coming across is starting to have a more significant impact on the market. And it feels like we kind of sit on our hands and wait between these events. But when they are occurring, it's giving us a little bit more of a glimpse into what's going on out there. And the market is becoming more and more sensitive to those particular events over time.
Sure. I mean, I agree. It does seem to be that, regardless of the data, the non-farm payrolls, it's not about payrolls really. It's about, how many people are going to be spending, therefore how quick is inflation going to go, therefore how quickly are the bank going to be forced into a corner. It all seems to just dial back to that one piece of crucial data that everyone's waiting for. But it just seems strange to me that we were at 2.5% Fed funds rate ahead of going into all of this. They've cut it right the way back, but a 25 basis point hike at this time almost feels incidental.
Yeah, potentially you're right, but I think a 25 basis point hike from when the Fed funds rate's at 25 basis points is quite a big change. And especially if the Fed's going to be the first central bank to move, because I guess that signals the fact that the US economy is significantly ahead of the rest of the world. And if we're looking at inflation rates that we've seen in the last few releases, we've got the US CPI at 5% year on year, which is massive. We've got the UK, the last one was around 2%, and then the Eurozone, you're at about 1%. If these sorts of levels are to hang around, that's going to start to force these central bankers' hands. When they start to move, the moves could be significant, especially if you start to see moves in the US in particular. When the dollar starts to move, you either jump on or you get left behind, basically. We saw last year, as you mentioned, the Fed fund rate come down from 2.5% down to 0.25, whereas the ECB moved from -4 to -0.5, so a tiny move. Giving up that yield advantage saw the dollar probably depreciate around 10%. If we're to see that yield advantage start to be restored, then you could see potentially big moves start to come back through into the dollar. And we talk about euro-dollar in particular here because that really is the key currency pair. I think it makes up about 28% of all FX trading volume. So when you start to see euro-dollar move in that particular way, then sterling dollar, everything else is going to get dragged along with it.
I mean, US inflation feels like a foregone conclusion at this point. And I get what you're saying about base effects. You go into a pandemic, everything shuts down, prices fall. So therefore, you're starting from a low base when things pick up again. But the amount of money the Fed's chucked into the market there, Biden's just about to get $1 trillion through in infrastructure spending as well, which is going to trickle into the economy as well. I mean, the only way is up, isn't it, really? And it's just a question mark of when. But are other economies going to not suffer the same fate, but are they going to find themselves in that position as quickly? Or does the US, streak ahead 6 months, a year ahead of anyone else, do you think?
Yeah, I think that's the key question at the moment. And like you say, the US has done more than everyone else, and it's probably no accident that they're in the position that they're in based on that. But you know, there are, I guess, levels of support in other economies as well, and perhaps some of the rebound in some of these other economies is more organic. But you know, at the end of the day, it's going to come down to, you know, it's a relative battle between each nation, and that's going to reflect in who comes out of this best. That's going to be reflected in the data that we see and the exchange rates. But you know, there's a number of different schemes going on in the UK, and you know, potentially the UK is still seen as an attractive place to invest. You know, we're seeing a lot of investment M&A activity. We've seen a potential purchase of a big supermarket chain from an overseas investor. So you know, I think potentially on a global scale, the UK is still not seen as you know, maybe it's seen as somewhere that's still a little bit undervalued. Maybe the pound is still seen as slightly undervalued, and there it's a good time to buy UK assets. But you know, I think the government's doing bits and pieces and doing what they can. There's a number of subsidies that they've put in place as well. Maybe something that you've paid a bit of attention to.
Well, it was the Nissan news that they're building a gigafactory, and Boris won't say how much the government's chipped in towards it, which I think is great. We need to get on the front foot with technologies, especially when you look at automotive in the UK and how big a part that is to the economy. It's nothing but good news. But I just, you know, you reference it to the US and you think, actually $1 trillion of infrastructure in the US should probably look like 100 billion sterling's worth of infrastructure investment by the UK government if we wanted to go like for like. And God only knows what the EU would say to that, particularly if it's, you know, direct support of private initiative. Whereas I think the EU's approach, albeit on a state-by-state basis, is, you know, here's your infrastructure money, spend it wisely, but probably spend it over time, and therefore there won't be any subsidy rules. So I just wonder if we're upsetting, if you can upset the relationship we've got with the EU at the moment anymore, whether this is going to be something that's going to cause a lot of friction. And then ultimately, I guess the small moves that we have seen, you know, from a sterling perspective, there is a lot of back and forth over the Northern Ireland Protocol, and we've just got a 3-month extension to the grace period, which should calm things down. But if it doesn't look like there's a longer term resolution, and as good as the EU are at kicking the can down the road, which we saw, you know, you'll remember the Greek debt crisis as well, you know, that was just 11th hour, let's move it on, 11th hour, let's move it on, for about 2 or 3 years. But at some point, the market's going to question whether the UK has got a long-standing trade relationship that can be built upon, or whether we're at this level now that actually we're foregoing that and looking into, you know, the Pacific partnerships and things like that to try and find growth, which is a much longer-term perspective. And that, for me, is there a justifiable gain in sterling over the course of the rest of this year and into next? And I think more than likely it hinges on that. So.
Yeah, and let's not forget about the financial services provision as well, which is
lest we forget.
still hopefully bubbling away in the background.
Yeah, you'd hope. I mean, you don't hear much on it, and normally it's no news is good news, but it does feel like, you know, all the time that this goes on, you know, the European bourses are just picking up business and clearing and taking it away from us, which gives us less argument and less of a, you know, sort of a key man risk in the UK that they want to try and satisfy by giving us a more level playing field. So I don't know. I mean, you know, some great minds hopefully working on the solution, but we're yet to see anything really. And they did say that it would be in and around March that we'd get something.
Yeah.
So we're only a few months behind.
Yeah, I think Rishi came out the other day and mentioned that it's been pushed out a little bit longer, but. Yeah, let's say at least it's something that they are potentially thinking about.
And I think Rishi's very wise to the fact that, you know, the financial services is, you know, 70 billion of tax revenue, and, you know, you need to find something for that. And if you're not going to get that revenue, or you're going to lose some of that revenue to the EU, then actually let's get out there quickly and use the fintech platform that we've got to try and to push into other markets. So hopefully he's got his fingers on the pulse. Time will tell.
Yeah, given the. I guess what's going on in the UK at the moment, and it feels like a lot of the chatter around the market seems to be somewhat UK negative in terms of what we've talked about with the borders. We've got the Delta variant. Even the Bank of England's slightly more dovish than what we're seeing out of the UK. And maybe thinking about the cyclical nature of sentiment in the market. Do you think this is the bottom in terms of bad news for the UK and we get better from here, or where do you think we go to over the next little while?
I mean, I hope so. I mean, if we win the Euros, then I think that that's definitely a quick acceleration up. But it is cyclical, isn't it? And if we can go through this cycle, and actually, Delta variant terrible, but first in, first out in many ways as well. And we are seeing an awful lot of progress. I think July 19th we should be business as usual, and potentially some international travel, and that hopefully will stem the any more downward trends that we've seen. But as Ian was saying earlier, we were talking about the train journey he had from Birmingham, and it's still empty. People aren't ready to come back in yet.
Yeah, well, I think in terms of we talk about people not really being 100% ready to commit to coming back to work, or what the next step is, because we've been burnt a few times already in the past, and it kind of feels like the similar sort of thing in the market right now, and that we've got a few people sitting on the sidelines. You look at implied volatility at the moment in the options market is down. It's about 50% lower on the 3-month cable implied volatility from September last year. It's about 25% lower from the start of this year. So what that shows is that people are really just sitting and waiting to see what the next catalyst might be, and looking to see where that might come from. And hopefully as we gain a bit more confidence and head through the next couple of months, we'll start to get a clearer picture on that.
So I was just going to say on that though, I think that we're used to, or for the last 12, 15 months, we've been used to big changes in numbers. Things have come in double digits down, high single digits up. And actually, as we get more on an even keel, then actually the market's going to have to respond to what is normalised data. Yeah. And actually a 0.2% move in something is actually an event. And I think once we can get to that point, then maybe things start moving again to a certain degree, because it has been very, very static. I read the other day that retail investors now are making up such a large part of not just FX markets, but less probably fixed income, but equity markets as well. That actually you get less big institutional moves, and a lot of these retail traders are taking out some of the noise from the markets by making a lot of smaller bets and smaller positions. And I wonder if that, though, counter to markets wanting to move again, actually sort of maintains a much smaller ripple when something does happen.
Yeah, it makes sense. Whether or not that's feeds through into the FX market or not as well, I guess is to be determined. But
a lot of retail traders to make up $4 or $5 trillion in global volumes a day.
Yeah, exactly. So, but you never know. There might be some big hitters out there.
We'll watch this space. So yeah, I think from a volatility perspective, it's been quiet. The markets have barely moved, and that was before summer. Now we've got 6-8 weeks ahead of us, where it actually feels like normally in traditional markets things wouldn't particularly move. Do you see any reason for that to be different this year?
Seems that the consensus around the market is that people are starting to step away from the trading desks already, and that we're going to come back maybe in July or August and see how the dust has settled. But the biggest risk to the market is always the unknown unknowns. And at the end of the day, if you're thinking about things from a risk management perspective, those are the things that we need to be protecting. The things that are that we know about that potentially hurt the pounder, you could argue already priced into the currency that we see today, into the rate that we see today. So we talk about low levels of implied volatility at the moment. Buying insurance with an FX option is relatively cheap. So that might be a different way to look at hedging some of your risk. But as it stands at the moment, the market is still very much focused on these data points, and I guess the key thing that everyone sort of has in the back of the mind is whether this rollout continues to go smoothly or not, and whether or not there's something else that could potentially blow up there that could affect the markets.
Like you say, the Donald Rumsfeld, the unknowns. I think it was him that coined the phrase, or Dick Cheney. But
Sounds good.
Watch this space and see.
Yeah.
Cool. Well, thanks for coming back in, and let's see where we are in a few months' time, and see what predictions we have to scrub from existence, or which ones we got right. Hopefully more than less.
Perfect.
Great stuff.
Thanks.